It's Adam Halpern here. I'm the president of Indicator Warehouse. About 2 years ago, in late 2010, I created a folder on my desktop. I called it the Ultimate Day Trading System. This file is where I kept every note and every request for any feature one of our trading customers sent to Indicator Warehouse. Now, many of these requests we've been able to accommodate with new indicators or upgrades to our present inventory, but there was a section of the file that took on its own life. In fact, it became the subject of ongoing conversations with veteran trader and my original teacher, Eric Senf. Let's face it, there are plenty of good systems out there, but they all have one thing in common. They all force you to wait for the good setup. Have you ever heard this one before? Trading should be boring. Or you need to sit on your hands and wait for a good signal. That's called being a disciplined trader. Well, the problem is, this is incredibly hard to do, especially when you sit there staring at an endless river of price action and potential profit flowing across your chart. I think you'll agree with me. It's pretty hard to just sit there and watch other people make money 24/7 while waiting for your system to alert you with a good setup. Often our patience runs dry and we get sucked into taking a trade just because we're so darn tired of waiting and would rather take the risk of a bad trade than wait for a better opportunity. In a nutshell, it sounds simple. Traders wanted a system that showed them a lot of good trade setups with as little risk as possible and, of course, as much consistent profit as possible. After 6 months of development and over 9 months of testing, the Diversified trading system is now available. DTS, as we call it, has not one, not two, but 3 signal generators, each designed to look at an instrument or correlated instrument in different time frames in order to reveal the maximum number of good trades available. The cool thing with DTS is that you can take 3 trades at once in 3 different time frames, never missing a good opportunity for a solid trend, swing, or scalp trade, all in one system.
How and why diversified trading works is the emphasis of this particular presentation. And it's funny, you know, diversification is such a common phenomenon in the whole realm of trading, and yet very few people, retail traders especially, consider diversification when it comes to their own personal trading. Yet diversification of your trading strategies is a way to limit your risk. A lot of times, most diversification is done the traditional way. You know, how does a day trader diversify? Well, the traditional approach is to diversify across a series of markets. So, for instance, you'll probably look at putting part of your portfolio into more aggressive markets, perhaps emerging markets, things that have higher riskiness to it, more volatile moves, and then you're going to put part of your portfolio into something that's going to more or less guarantee you a return, something like a 30-year bond. Even though the return may be small, or a savings bond of some sort, even though the return may be small, at least it is more or less guaranteed. So that is the traditional way that most people diversify their portfolios to try to minimize their risk and protect your investment. But in a similar fashion, day traders can also diversify across market conditions to limit their risk exposure and protect their investments. Now, it's funny, when I first mentioned this to people, they kind of have a blank look on their face because a lot of them have never considered this, and it usually leads them to an aha moment where it's like, yeah, why didn't I think of that? you can actually diversify your trading and protect your investment by limiting your risk exposure by looking at scalp trading, swing trading, and trend trading all at the same time. Those are the three dominant market conditions, which the market will have at one or all the time. So by looking at these different market conditions simultaneously, you are actually protecting yourself a little bit as far as your risk goes. And like I said, a lot of traders rarely consider this concept. They tend to put themselves into one of the three trading categories. If somebody asks you, what kind of trading do? You say, oh, I'm a scalper, or I'm a swing trader, or I'm a trend trader. And they tend to trade according to their label. But there's two problems with this. The first problem is that you're cutting yourself off from additional opportunities. For instance, if you're only looking to be a scalp trader, that may be all well and good when the market conditions are ripe for scalping, but how many times have you scalped in and out of a trade and watched the market, move 10, 20, 30 ticks without you and without giving you a subsequent signal? And likewise, if you're a trend trader, how many times have you gotten into a trend trade and the market has fallen flat, or it didn't go anywhere for half an hour or an hour or longer, and meanwhile it's just chopping back and forth, and you're not able to realize any profit because you're trying to trend trade it, whereas if you had been scalping at that time, you would have done a little bit better. So that's problem number one. The second problem that you have is that if you're only using one signal, it's not going to work with every market condition. One size does not fit all when it comes to trading. And this is what catches a lot of people by surprise. They think that if you have one signal is as good as the rest, or if you have a relatively effective signal, that it's going to be effective in a scalping environment or a swing trading environment or a trending environment. But as anybody who's been trading for a while knows, that's not necessarily the case. Sometimes your signal will work just fine, and other times you'll be scratching your head wondering why the market is kicking your butt. That's because the market conditions are changing and you're trying to use the same signal for every single condition. It's like my grandfather used to say, if the only tool you have is a hammer, then you tend to see everything as a nail. It's the same thing when it comes to trading. So it's actually important to recognize that there are three market conditions, but not all three are equal at the same time. Sometimes the market will be more of a scalping environment. Sometimes the market will be offer up swing trades, and sometimes the market will be trending. Your job as a trader is to take advantage of the prevalent market condition by using the right tool for the job. And like I said before, a lot of people have the tendency of thinking, well, my signal is a good signal, it works X% of the time, I'll just apply it across the board. But you would find that you would have much better success if you looked at the market and said, okay, my signal works best in a scalping environment. So either you're going to limit yourself to scalping environment, or you're going to say, I'm going to use this signal for scalping, and I'm going to use this signal for swing trades, and I'm going to use this signal for trend trading. So the easiest way to modify your trading system is to change your time frames. In most cases, shorter time frames work best for scalping trades. Longer time frames work better for swing and trend trades. But this is not the ideal situation because you're still working with your only tool is a hammer. So every problem you see is a nail. kind of scenario. You need the right tool for the right job. The signal should be customized to reflect the market condition. So scalping markets require different signals than swing trading or trending markets. Now, like I said, when I mention this to people at first, they kind of get a little bit of a puzzled look on their face, but after they think about it for a while, and especially once you start to do it, then you're going to realize that, yes, there is something to this, and you will be surprised, actually, how well it will work for you. And in a moment, I'm going to show you how I do it. But first, before we get into that, the most important thing to remember when you are looking at building a system that has multiple signals is that you keep your signals clear, simple, easy to interpret. I can't tell you how many people I come across who become so obsessed with finding the perfect signal that all they do is pile on another indicator. You tweak another indicator. Look for, they buy another software package. The list goes on. And sometimes the chart becomes so cluttered, you can barely see the price bars underneath. And I am not kidding you, folks. I have seen some real doozies. It's almost like a bowl of spaghetti has exploded on your chart. You cannot trade that way. Trading is much more than just getting a good entry signal. Listen, I'm going to put your mind at ease right now. If you think that the reason you are not a successful trader right now is because you haven't found the right entry signal, you are wrong. There is much more to trading than finding the perfect entry signal. In fact, there is no perfect entry signal. By definition, the markets only move when they are out of balance. So if you had the perfect signal, you would essentially be ending up balancing the market. It wouldn't take long for traders to figure out what's going on and that and sooner or later the market would be balanced. And then there would no longer be any moves. Everybody would be wanting to buy, nobody would be wanting to sell. Everybody would be wanting to sell, nobody would be wanting to buy. And that's not the way trading works. There is much more to trading than just finding the perfect entry signal. In fact, as any Wall Street trader will tell you, Wall Street is over the moon if they can find a signal that works 55-60% of the time. Why? Because they know that having a decent signal is important. Don't get me wrong, you need to have a reasonably good signal. But it's money management and how you're going to manage your trade that is really going to make the difference. All right. So when the market is unfolding and prices are coming at you, you have to be able to make a decision quickly and clearly and be able to make that go, no-go decision without any hesitation. And if you're unable to do that, then you need to refine your system to the point where you can actually do that, because it is that important. All right, so let me see if I can get you my charts now. And you'll see how I do it. Now, let me walk you through this. This might look a little overwhelming at first, but it's not as bad as it seems. What you're seeing here is it's actually a system that's been developed to exactly address this issue that we're talking about today. It is called the Diversified Trading System, DTS for short. And the reason it is a diversified system is because we have tools to pick up scalping trades, tools to pick up swing trades, and tools to pick up trend trades. And I'm just going to go over these briefly so that you can kind of get a feel for the kind of thing that you might want to be looking for when you're looking at developing your own system. So I've actually got 6 charts on here. There's 2 markets. On the left I have the NQ, the NASDAQ. On the right I have the YM, the mini Dow. And traditionally I watch 4 markets. So I've got the NQ, the YM. Sometimes I'll be watching the 6E. Sometimes I'll be watching the British pound. And I usually watch crude oil. So I have a little bit of diversification among the markets. So I have crude oil, which is going to be my most volatile market. I have the 6E, or the British pound, one of the currency markets, which normally tends to trend a little bit better, so it's a little bit more conservative. And then here in the middle of the road I have my stock indices. Now I realize you only see the stock indices here. The 6E and the Euro are on my other monitor, but you get the idea. So the way this is organized is the 2 charts at the top, or my charts at the top in general, are my scalping charts. So when I get a scalping signal, and with DTS there's actually an audible warning, which is very helpful when you're looking at different market conditions, to have an audible alert to say, scalp, swing, or trend, so you'll know where to look. But at the top here I have my scalping trades, in the middle I have my swing trades, and at the bottom I have my trend trades. Now let's just take a moment here and we're going to take a look at what this scalper looks like. I'm going to turn this off. I'll address that in just a moment. Now this particular tool has actually been customized to pick up short-term shifts in price and momentum. And we took great pains to make it easy to interpret. And the way it unfolds is when part of the market conditions are being met, the program actually prints a warning dot, which is like the red dot that you see down here, or these green dots that you see up here. Those are warning dots. When those develop, I'll get the audio alert and it will tell me that I have part of the conditions of a scalping environment. When the rest of the market conditions are met, I get a triangle and a hash mark, which is a suggested entry point. Now the triangle tells me that all the market conditions are being met, and then it's up to me to decide whether or not I want to take a signal. Now there are some very simple refinements within this, but I can tell you quite instantly, looking at the chart, whether or not I want to take a signal. Like here, for instance, this particular signal right here, that is what we refer to as a first micro-macro crossover. So we have these 2 trend lines on here. The thin one is called the micro line, the thick one is called the macro line. When everything comes into sync and I get a signal, I know there's a good probability that that signal will have some follow-through. So very easy to look at, very easy to make a decision off that. And like I said, the way this chart is organized, it's not only easy to interpret, but the signal itself has been customized to pick up on a scalping environment type of scenario. Let's take a moment here. I'll take a look now at the swing trader. Swing trader is here in the middle. Now you can see it's similar, but it's also different. Here with the scalping, or pardon me, with the swing trading tool, this particular tool, the signals are interpreted the same way, so I don't need to learn a whole new system. It's still will print a warning dot when the signal begins to develop. When the rest of the signal parameters are met, I'm going to get a triangle and a hash mark, and then it's up to me to make the decision whether or not I want to take a trade. So as a for instance, up here we have a very good trade setup, and this particular setup is one that we refer to as a down, up, down, and it usually occurs after a trend change. So here we have a trend change, and then we have the market going down, It fires a signal to the upside, and then it fires a signal to the downside. So there it prints our signal. And once I have the trend change, I begin looking for that down, up, down, and I get my signal, and you can see that one had some fairly nice follow through to it. Again, very simple to interpret. No guessing. I can look at it and I can make a decision instantly whether or not I want to take that trade. So those are the kinds of things that you're going to want to look for when you're developing your scalping system or your swing trading system. And remember, as I said, the easiest way to customize your parameters is by looking at the time frames, not only looking at the time frame of your chart, making shorter time frames for your scalping tools versus your swing trading tools and your trend trading tools, but also looking at the time frames of the tools themselves. So for instance, if you're looking at perhaps using a moving average crossover system, in your scalping environment, you'll probably want to go with a faster pair or triplet of moving average lines versus something that you would be using for your swing trading and trend trading, where you're going to lengthen the parameters a little bit in order to try to pick up on those swing trading signals or to capture those market swings. Let's take a look at the trend trading tool here for a moment. And this is what we call the Eagle Trend Trader. And once again, you can see it's similar but different. Now, this tool has been developed to try to pick up on emerging trends. And essentially, the signal is the same again. You know, we get warning dots, we get triangle and hash marks when the signal completes. You can see here was a signal that completed, but it never fired. It never went any higher, didn't bring us in, so that's all right. No harm, no foul. Here's a signal that did complete, and you can see a little bit of a move to the downside, but not exactly a huge trend, not yet. Obviously, these are the kinds of trends that we're trying to take advantage of, and again, it's the kind of situation where when you look at the chart, because the signals are relatively simple and easy to interpret, it's easy to make a decision off of these. So I get the warning dot, I get the triangle and hash mark. It's telling me, okay, the market conditions are ripe, so let's take a look at perhaps taking a signal. And after that, the decision becomes mine. Is it a situation where I want to take a trade? And for instance, here we had the market turn over, and we're testing the hard edge. That we call this the hard edge of the band, and we get a hard edge bounce, and you can see that there was fairly nice follow through from that. So those are the kinds of things that you want when you are developing your system. Obviously, you want to tweak the tools to pick up on the market condition that you are trying to capitalize on. Now, I have a couple other tools on here that I'll just touch on briefly because I know you're going to be wondering what they're about. Here in the top left corner, this is a little tool we have called the Trade Forecaster. It's actually a pretty cool little tool. It's similar idea to what we've been talking about with the whole diversification, but what this particular tool does is it tries to tell you what the dominant market condition is and what the next one will be. So right now it says that the trend is the strongest market condition at the moment, even though, you know, the markets are closed now, so it's probably kind of just stuck on the trend mode from how the market was closing out. But it's saying that in about an hour's time, the conditions are going to change so that it's going to be more of a swing trading environment. Like I said, I don't pay too much attention to this in the after hours, but it's fairly helpful during the session. But more important than that, remember how I mentioned to you, the signal is only part of the equation. The other part of your diversification that you're going to need is your risk management and your trade management. All right, you're going to need all the pieces of the puzzle in order to make everything work. So once again, we have this tool here that does it for you, but you can also do it manually. First, let me talk a little bit about the risk management itself. A lot of people make the mistake of risking far too much money on their trades. You may or may not have heard that you should only be risking, well, certainly no more than 5% of your trading capital on any single trade. And ideally, you should only be risking about 1 or 2%. Now, I realize if you're a small trader and you're trading, a $10,000 account or less, risking 1 or 2% is not exactly going to be feasible. But you should still endeavor not to risk more than 5% of your capital on a trade. The reason is you're going to, if you hit a series of losers, which we'll all do from time to time, you could seriously damage your account. And yet I see traders all the time saying, oh, I'm going to be conservative. I'm going to limit my risk. I'm only going to trade 2 contracts. Or I'm only going to trade 3 contracts. And that is the death knell for your trading account. Let me repeat that. If you are trading the same number of contracts on your account, regardless of how much risk there is, you are going to wipe out your account. The reason is you end up risking the same, you end up risking more, say if we're going to short here and cover up here. If you're trading, say, 3 accounts or 3 contracts all the time, you're going to risk, a certain amount here. Let's say it's $1,000. But if you risk, let's say you decide to risk it up to here, and the risk from here to here was $1,000, and the risk from here to here is $2,000. Well, if you're trading 3 accounts all the time, or 3 contracts all the time, you're going to be risking $3,000 to do this trade, and you're going to be risking $6,000 to do this trade here. Right? So $3,000 for this trade, $6,000 for this trade, or whatever. I'm just using thousands as for easy math. If this big trade goes sideways, of course, you're going to hurt yourself a whole lot more than if this trade goes sideways. So what should you do? The prudent trader only risks what they can afford to lose. So if you're trading, say, a $10,000 account, and you want to limit your risk, I don't know, let's say you're going to limit your risk to 3%. So that means that every single trade, you will only risk $300. So let's say, for instance, that this trade from here to here is worth $300. That means you are only going to trade 1 contract. If this trade from here to here is worth $600, but you can only afford to lose $300, then you're not going to take this trade. All right, that's a very important concept to get your head around. And likewise, let's say the trade works out like this, where it's $150 from here to here, and you can afford to risk $300. Well, then you are going to take 2 contracts. All right, so like I said, very important concept for you to understand. It will make the difference between your success and failure as a trader. I can virtually guarantee that if you ignore this concept, you will fail at trading. I can't guarantee that it will make you successful, but I can guarantee that it will sink you if you do not pay attention to this. It is that important. The last key to diversification is your trade management. And just like your signal, your trade management has to be very clear and concise. Now, this particular tool here that you see on the right, this is what we call the Trade Manager. It does all this kinds of things for you automatically. But like I said, you can do these things manually as well. Let's say, I'm going to just turn this on here. These blue dots that you see here, this is my, at the moment, it's my average true range. So average true range multiplier of 2.618, fancy little Fibonacci number in there for a period of 14. I can adjust this however I want to be more or less aggressive. A Trade Manager will automatically exit any active position when one of these blue dots gets tripped. So it's designed to make trading multiple contracts, multiple markets at the same time simple. You know, I can quite literally trade all 12 charts simultaneously with this particular tool because it figures out my position size. I do the order entry, and after that it manages my trade for me. But you can do these things on a smaller scale as well, right? You can, if you're just starting out, you shouldn't be trading 4 markets. You should probably be concentrating on 1 or maybe 2. And then as you get a handle on those, then you can look at adding a few more. But the important thing is that, as I said, you have a system in here that you're able to look at it and you're able to say, yes, I'm going to exit at such and such a point. That you don't leave your trade management to guesswork. And it can be something as simple as, I'm going to trail my stop 2 bars back. So here's my entry, 2 bars back. I'm going to put my stop above that high. And as the market goes down, I'll trail my stop, so it's always 2 bars back. All right, so that very, very simple stop trailing methodology. It's actually fairly effective as well. But the point is that you do need something that is going to be simple, be clear, and something that you can execute immediately without any guesswork. Because probably next to poor money management, poor position size or risk control is poor trade management as far as what is going to make or break you as a trader. So there you have the 3 ways of diversifying your trading across 3 different market conditions. So you're looking at scalp trading, swing trading, and trend trading, and you're also able to diversify across the markets by looking at conservative markets, middle of the road markets, and even more aggressive markets. Like, I would not suggest to anybody that you trade, say, gold and crude oil and make those your solo markets, because you're looking at 2 extremely volatile markets. If you hit, great, fantastic, you'll make a bundle of money. When you don't, not so much. It's going to be a lot harder. All right, now I kind of breezed through some of those points. I wanted to leave a little bit of time here if there were any questions. So let me see here. There's a question here from Chris. Can you explain the significance of using the 6-tick Renko bars for scalping and the 8-tick for swing trading? Absolutely. Good question, Chris. Now, I did mention that the easiest way to simulate a scalping environment, a swing trading environment, and a trend trading environment is to adjust your bar size. So that's essentially what we're doing here. These are the mean Renko bars that I have displayed here. The mean Renko bars are a tool that comes standard with the DTS system. It's what it does. Mean Renko bars, they're essentially a blend. I wish they'd given it a sexier name than that, but it's essentially a blend of Renko bars and candlestick bars. So it takes all the strengths of a Renko bar and its ability to identify ranges and support and resistance areas. Like you look at this, very obvious. We got resistance up here, very obvious. We have support down here. So it takes the advantages of the Renko bars, but it also gives you the feedback that you would get in candlestick charts. So for instance, we can see that this is a rather bearish looking candle. It's also like an engulfing candle. And so you get an engulfing candle like that, and you get a break of a support area, and then we get a signal to sell a few ticks later. Yeah, okay, that's probably going to be a pretty good signal, and lo and behold, away it goes. So what we've done here, we did a lot of experimentation with these different charts to come up with standardized settings for most of the markets. And the scalping tool is set at 6 ticks, and again it helps interpret the scalp signal because the signals will tend to develop a little bit faster, which is what we want from our scalping tool. The swing trading tool is set at 8 ticks, which is middle of the road, and then the trend trading tool is picked up at 12 ticks, and the idea there is to filter out some of the market noise and pick up emerging trends. Now, if you're not using the mean Renko bars and you're using, say, time charts, you can simulate this by perhaps looking at a 5-minute chart for your scalping tool, a 15-minute chart for your swing trader, and maybe a 30 or 60-minute chart for your trend trader. So those are the kinds of things, an easy way to adjust your system to reflect the different market environments, because obviously an hourly chart is going to look different than a 5-minute chart. You're going to get a lot less noise, and hopefully you'll be able to see a trend as it's building. The question here, can you use Renko bars? Well, yes, the charting style itself is not going to make or break your system. There's a lot, don't get me wrong, there's lots of advantages. I really like these mean Renko bars. But if your eye is toward candlestick charts, then great. If you're looking at Kagi charts, fantastic. Again, so many people get so caught up in thinking that, if I just found the right combination of things, I would be successful. But the only true combination of things is that you have a decent entry signal, and you combine that with good risk management, i.e. don't risk more than you can afford to lose, i.e. don't risk more than 5% of your account ever, and combine that with good trade management. If you do those 3 things, then you're going to be well on your way, and you're going to start printing some numbers in the black for a change. But are you going to be successful if you look at Renko bars versus 5-minute chart or regular candlestick charts? No, that's not going to make a difference. Before I was introduced to these mean Renko bars, I traded a 5-minute candlestick chart forever. And before that, I traded a daily bar chart. So it's not that the chart style is going to make or break it for you. If you have a chart style that you can decipher a decent signal from, then go with that chart style. If you're looking for a chart style, I can strongly recommend these mean Renko bars. They are excellent at condensing the market information, showing you, like I say, clearly showing you support and resistance areas. That's really one of their strengths, is you can see quite plainly support and resistance. You can see when the market is breaking down, and you get a little bit of feedback because, like I said, they have the power of a range bar or the Renko bar combined with the feedback and the sensitivity that you would get from a candlestick chart. But will it, make you rich if I tell you to change, hey, everybody go buy mean Renko bars? Is that going to make you rich? No. I wish it were that easy, but no, there's other things involved. Here's a question. What account size is needed to trade the multiple market as shown? Excellent question. Because these are day trading markets, or we're day trading these markets, the tick size is going to be paramount in determining how many of these markets you're able to trade. I'm a big fan of the NASDAQ and the mini Dow, the NQ and the YM. They're only $5 a tick, so they're very affordable. They make the exact same moves as the E-mini, but whereas the E-mini is $12.50 a tick, at $5 a tick I can afford 2 contracts instead of 1. And depending where my risk, where my stop loss order is, sometimes I can even afford 3 contracts, where I might only be able to afford 1 in the E-mini. So it gives me a little bit more flexibility. I much prefer trading a multiple number of contracts versus a 1 lot. I find it really, really difficult to manage a 1 lot. You know, you hit your profit target. Do I take profit? Do I roll my stop? What do I do? But if you've got 2 or 3 contracts, well, you can punch out. Take contract on, or take profit on half your contracts and roll the stop to break even, and if it goes to the moon, fantastic. At least you're still in the trade. But if you're trading a 1 lot, then it's a lot more difficult to scalp, swing, and trend trade all at the same time. Because sometimes you're going to be in all 3 conditions, right? Like if the market is picking up in a trend, this will happen to me a lot actually. When the market begins trending, well then obviously we're going to get swings during that trend, and we're going to get scalp trades during that trend. So I'll go in with a trend trade, and then, you know, maybe a minute later or 30 seconds later, I'll get a signal for a swing trade and a scalp trade. So I'll punch into those and I'll take profit as those go on. And in the meantime, the trend just keeps going and going and going. So you need a little bit of capital to allow you to take advantage of all of those. When I'm doing all 4 accounts here, and we're doing it, you know, public on a sim account, we're usually simming a $25,000 account. As all things trading related, the more money the better, right? You don't need to spend it all, but the more money you have in your account, the more flexibility it would give you. But $10,000 would probably be the least amount of money that you want to look at in order to scalp, swing, and trend trade at least 1 market. And if you're trading the YM and the NQ, you may even be able to sneak 2. Here's a question. I use my proprietary indicators with Heiken Ashi. Do you think the DTS will work well with that? You know what? That is perhaps the only charting style I haven't tried on here. Let me show you. Like the DTS system, it will provide signals on practically any chart style. So let's say, just for kicks, oh, I don't know. Let's do a 5-minute chart. That's easy. Where are you? 5 minutes. So here's a 5-minute chart on our scalping tool. You can see it's still generating signals, right? Here was a nice first micro-macro crossover. Here was a nice signal that printed, the warning dot, triangle hash mark. It had a little bit of follow-through to it. I know a fellow who trades tick charts using DTS, and he does very well. I can't say for certain whether or not it will work with your particular charting style. But it works with practically any chart style, with the exception of point and figure charts. And there is one other chart style that escapes me at the moment. I think it might be line break, where we just get, oh no, it works with line break too. You see here was a warning dot. Yeah, well, it looks like it actually works really well with line break. Here's a warning dot, here's the triangle on hash mark, caught that move very nicely. Here's another one, caught that move pretty well as well. So everything but point and figure and one other chart style. So I would say it probably would, but of course I can't guarantee it without actually trying it. Here's a question. Are the mean Renko practical for trading slower moving stocks? Yes, actually we have a stock trader in the indicator warehouse fold, Michael Filiguera, and he's trading Apple and Google, and well, those are a little bit faster, but yeah, short answer, yes. He's trading stocks with DTS and with the mean Renko bars. The mean Renko bars, like I say, it's just a charting style. It's not. It certainly has advantages. Don't get me wrong, but it's not the chart style itself that's going to make or break you as a trader. It's the chart, the signal, the money management, and the risk management. But to answer your question, yes, definitely. The mean Renko bars will work on stock charts. Let's see here. I have a question. On the scalping charts, you have 3 colors. Again, this is something that we've programmed into it to make it easy to interpret. I know when the bars are green, it's a bullish environment. When the bars are red, it's a bearish environment. When the bars are yellow, the conditions are too neutral for me. I don't really want to trade. Now, there are a couple of exceptions to it, which I'm not going to get into now because this isn't about DTS training. But again, the whole point is to be able to look at a chart and be able to make a decision instantaneously whether or not you're going to trade or not trade. The signal itself is very easy to interpret, and it develops in 2 stages. And this is going to be true for all the DTS systems. We designed them to generate similar signals so that when the market is unfolding and the trades are happening, you're actually able to make a decision very quickly. The way the signal develops is it develops in 2 parts. The first part of the signal is this warning dot. You'll see this warning dot print when the first parameters are being met. When the rest of the trade parameters are met, the system will print a triangle and a hash mark, which is your suggested entry. The triangle and the hash mark confirm that you have a complete signal and that it's time to enter the trade. With the Hawk microscalper, what you want is you want for everything to be in sync. Your best signals will come when you have your bars, your signals, your micro trend line, your macro trend line, and your filter all in sync. So you can see here we have a signal. We got a green warning dot, a green triangle and hash mark. Our micro trend line is green, the macro trend line is green, and the filter is green. So that generates a buy signal. We would place our order at the hash mark, and you can see we had some very nice follow through from here. A little while later, we generate another signal. Again, we would enter at the hash mark. We took a little bit of heat, generated a couple more signals, and again, we had very nice follow through. Here is a sell signal, but notice this is a sell signal we would not take because it is all out of sync. We have a gray macro trend line, we have a red micro trend line, we have a yellow bar, and we have a red filter. So this is not an accurate signal. Notice back here as well that we have a green bar with a red sell signal. That too is not an accurate signal. You'll notice that our macro trend line is also out of sync. Look for the warning dot. Look for the triangle and the hash mark that complete the signal. Make sure your bars, your micro trend line, your macro trend line, and your filter are all in sync. That will always give you your best trades.
Hi, it's Adam Halpern here. I regularly send out customer feedback questionnaires to find out what we can do better at Indicator Warehouse. This is how we've been able to build better software, training programs, and trading rooms that truly serve the needs of day traders around the world. Recently, I had my world rocked, and today I'm going to pass this information to you because this is something you'll want to take straight to the bank. As you know from our reviews page, we have a constant flow of traders happy with our products and services. And for that, I give thanks to the team at Indicator Warehouse, which includes the best Ninja programmers in the industry. But it's not all sunshine and roses for everyone. There are some traders who, even though they appreciate our support, training rooms, and training, still struggle to be consistently profitable. Now, why are they struggling? That's what I really wanted to know. My idea was, if we could know where they're having difficulty, we could address that and probably help. So in the last round of feedback, we had the greatest number of traders reporting success with DTS than ever before. Of course, that was cause for great celebration, but I couldn't break out the champagne just yet. You see, there was another distinct group of traders that were still struggling to grow their account, be it in simulation or with real money. Now, this is not really surprising. In any classroom, there's always a group that leaps ahead and another that still needs more time to catch up. Nonetheless, I wanted to know exactly what I could do to help speed up their success. So to get a better picture of these traders, I cross-referenced their feedback to the other two groups and the products that they owned. I discovered something that I really didn't expect. There are three types of DTS owners: those who own all three birds, those who own two, and those who own just one. Now, of these three groups, which do you think has the largest proportion of traders having difficulty reaching consistent profitability? Now, before I tell you the results, let's back up a second. What makes DTS such a unique trading system is that instead of being just one tool, we split it up into three sharper or smarter tools. That is to say, each bird produces high-quality signals for the market condition it was designed to watch. So here is something you may have experienced. If you own the Eagle Trend Trader, for example, it will not fire a signal unless the market is indeed trending. On the other hand, a one-size-fits-all system will fire a signal, but unfortunately you're still in the dark because you don't know if the market is setting up for a trend, a swing, or scalp trade. With DTS, however, you do know because the birds are smart when it comes to recognizing and killing the prey they were designed to catch. This enables you to trade with much more confidence and success in the market conditions of your choice. For example, if you're a trend trader and never want to be anything else, you just need the Eagle. We even had trading psychologist extraordinaire Richard Frazan design a free trader's assessment test to help you find out your core trading bias, be it trend trading, swing trading, or scalp trading. With trader test results, together with the demos from Stephanie and the questions answered by Eric and Omar, traders have been able to gain a solid understanding of their trading bias, thereby matching their personality with a specific market condition and respective DTS bird. With that in mind, which group do you think is having the most difficulty growing their account? To be totally honest, I really thought the three bird owners would have the steepest learning curve to profitability. My logic being that there was more for them to learn and get used to. Turns out I was dead wrong on both counts. Learning to trade with three birds is no more complex than learning just one. After all, they all look and act the same way, even though the math behind them is distinctly different. The group with the largest number of traders still struggling are the one bird owners. On the surface, it doesn't make any sense. Why do three bird owners find it easier to make money? The reason is because if you have just one bird, you must be disciplined enough to trade only the market condition for which that bird was designed. Now, Eric has confirmed that when one bird owners contact him for help, it's most often the case that they are taking trades they shouldn't be. That is to say, they're trying to get their bird to kill prey it wasn't designed to hunt. With one bird, you must only take trades when those market conditions arise, period. For a number of one bird owners, they are indeed satisfied to trade just one type of market condition. In fact, some days they don't take any trades at all because those market conditions don't arise. In other words, if the waves aren't there, they don't surf, and they're okay with that. If you're trying to get your one bird to hunt things it wasn't designed to kill, you'll probably take bad trades and continue to struggle. If that's the case, it's time to make a course correction on your journey to consistent profitability and to add the remaining birds so that you can trade during all three market conditions. On the other hand, if you resolve to tighten up your discipline with the 1 or 2 birds you own, then this video can simply be a friendly reminder to do so in order to be consistent and profitable. However, if you would like to avail yourself to trading the maximum of solid signals in all three market conditions, I'm going to make this easy for you. Here it goes. When you have 3 birds hunting, the birds actually talk to each other. They actually tell one another what the market is doing from their perspective, and you, the trader, receive this information. Let's look at an example. First, the hawk fires a solid signal to get into the market. A short time later, the falcon fires a signal in the same direction, and the hawk fires again as well. The 2 birds are telling you that perhaps a trend is setting up. Indeed, your eagle is standing by looking for the kill. The eagle fires, and so does the hawk once again. The result? 5 good trades in 3 market conditions, and you were able to capitalize on all of them because you own all 3 birds. But if you're intent on maximizing the available trading opportunities of the day, you must be sure you have all the right tools. The $22,000 trading room. How our trading room moderator grew his account 89% by trading just 2 hours a day, and the story of why a group of traders put their heart and soul into finding a path to consistency and instead got slaughtered in the markets. Hi, my name is Adam Halpern, and I'm the owner of Indicator Warehouse. If you're watching this video, then I'm guessing you've reached a point where you've had enough of the overpriced courses, robots, automated systems, complex methodologies, expensive trading rooms, or any other shiny trading object in lies. Well, that's actually a good thing, because maybe you're finally ready to get serious about trading for real. In the next few minutes, I'm going to show you how to trade futures, forex, and stocks with no gimmicks or ridiculous crystal ball promises. Real trading for real traders. If you're a beginner, you'll be getting started on the right foot. And if you have trading experience, you'll love the advanced strategies for consistent, profitable trading. In the last profit run session of our trading room, Eric Senf grew his account from $25,000 to $47,246. That's a 89% gain. We recorded the entire 49-day profit run on video so you can see Eric taking the live trades for yourself. In a minute, I'm going to tell you how to get free access to the very same trading room with Eric Senf. But first, I need to tell you a story about a group of traders who are getting killed in the markets despite the fact that they've been giving it their all to become better traders for quite some time now. Some of them have been trying for years but may never break through for a very specific reason. I hope you're not in this group, but if you are, you'll discover why this quick story has become the aha moment for traders who finally found the path to consistent success. In June of last year, a trader contacted me and wanted to know more about the Diversified Trading System, or DTS. I can't use his real name, so let's call him Trader Joe. Joe was quite the skeptic, which I can appreciate because I was the same way. In fact, I like traders to be sure before they buy from us. He had a lot of questions, and I really appreciated that too, because that enables me to put these questions on our website for the benefit of everyone. Apart from being skeptical, Joe seemed a little depressed, like the wind had been knocked out of his sails and he was just drifting, not knowing what to do next. Now, I'm always trying to learn more about the traders we serve, so I dug a little deeper and asked him how long he's been trading, what instruments he traded, and what systems, software, and rooms he had tried. My heart started to sink as I heard the familiar story of expensive courses, automated trading software, high-priced trading rooms, and self-proclaimed gurus. Joe had spent thousands of dollars and countless hours trying to become a consistently profitable trader, but quite frankly, didn't have much to show for it. As you've probably noticed, online trading forums are littered with stories just like Joe's of how much they spent on education, software, and trading rooms, and yet, like Joe, they still struggle. What's happening here? I think we can all agree that trading is not for the light of heart. However, that is not why traders like Joe are failing. Put yourself in Joe Trader's shoes for a moment. You come across a website that offers you day trading education. The seller's been around a long time, there are a lot of testimonials, and there's good word of mouth about it. Everything looks great, so you go for it. Well, there's one catch. There's no trading room. Now let me ask you, you wouldn't teach someone how to cook without actually cooking, right? If you're taking a trading course, you need to see the instructor take live trades directly based on the course material you just purchased. And you need to see this day in and day out, as many times as it takes for it to sink in. In my humble opinion, a course without an ongoing trading room is useless. You're just left hanging there with some new trading knowledge and strategy, but not sure how and when to apply it. There's a reason why you have to become an intern before you become a doctor or lawyer. After you've done the coursework, you still have to live it, so it all sinks in, and you must have mentors there to guide you. Sadly, this doesn't happen much in the trading world. Okay, on with the journey. Next, you come across some very attractive trading software. You decide to give it a try. Unfortunately, it's not related to the course you just took. Now it's just another piece of the puzzle, and not enough to create a complete picture that enables you to break through to consistent success. Basically, you just bought a food processor for your kitchen, but at the end of the day, you're not a better cook. Next, you try a trading room, but again, it's not related to the course you took or the software you just bought. Just another puzzle piece that doesn't fit the other ones you already have. It doesn't make sense to have an education that has nothing to do with your software, or join a room where the moderator doesn't follow what you've learned in the course you took. Imagine trying to cook Chinese food after taking an Italian cooking course, or using a microwave and your coach is a French chef. It's just not going to work, and it's the very same reason why Joe and traders like him are chasing their tails on a quick path to nowhere. Simply put, it's an expensive waste of time. Now I think you'll agree that what you really need is to have your trading education, your system, your software, your trading room, and your trading mentor all on the same page, using the same proven tools and trading methodology to trade successfully. This is what makes Indicator Warehouse so unique. We are the only NinjaTrader vendor to offer a comprehensive education in both futures and Forex. We include trading software, trading rooms, mentorship, and the same winning approach every step of the way. It's the shortest distance you'll find to consistent profitability. The best thing is, our package and system never get old because it's rooted in the unchanging nature of trading, as opposed to some gimmick or loophole that might work for a while but eventually turns against you. DTS is straight up trading, and frankly, you should never have to buy another course, system, or trading room ever again. Yes, I know our company name, Indicator Warehouse, might throw you off. At first glance, you might think we only sell indicators. Well, that was true when we opened our doors back in 2009, but since then, we've pulled all the pieces of the puzzle together into one comprehensive yet affordable package. There are few teachers and trading room moderators as good as Eric Semp for teaching you futures, or Omar El Tuki for teaching you Forex. They know their stuff, and they're happy to take whatever time you need to run with it. Remember how I said Eric grew his account by 89% in just 49 trading days? Here's what Eric wrote to his students at the end of his last session, and I quote, "Yes, these were my results, and while I would love to convince you that I'm some sort of uber trader, I'm not. With DTS, these could be your results too. The whole point is to show you that DTS combined with proper money and trade management does work. With DTS, you have a leg up on your journey to becoming a successful trader. I want to encourage you to keep at it. Don't abandon your dreams. Don't give up on the freedom you will gain by becoming a successful trader. You can do it. You will do it. If you have any questions or need any help, please ask. I'll do my best to answer. After all, that's what I'm here for." Thanks for joining me on the Profit Run. Your friend, Eric. In a nutshell, Trading with any of the three DTS systems is easy to learn and easy to use. They make your trading decisions fast and decisive. There's never any panic while trading. It's a calm and straightforward process. And with our Trade Manager tool, you'll always trade the right number of contracts, enter with the correct amount to risk on any trade, and take the maximum profit from each position. Trade Manager instantly leaps you ahead by dramatically reducing your trading risks, protecting your account, and fully maximizing your profits.